Hey, what's going on? My name's Leo, and welcome back to the Small Portfolio Challenge. This series is geared towards helping motivate you to start building and investing and creating wealth for yourself, making your own investment portfolio. So let's go ahead and dive into this month's update. So we're looking at the portfolio here, and you'll notice that, coming over here, we started with nothing, right? And we put in that first, I believe it was $200 to start the account. And you'll notice that just every month, the key to building an investment portfolio, and really the key to accomplishing anything that you want to do in life, is just showing up. If you just show up and you deposit the money every month and you build that momentum, and you can see that here where, that first month was $200. Okay, now we went up and now we got, what is it? I think the next month we did $500, and it just staircases. And in the early stages of growing an investment portfolio, really it's not so much about trying to pick a lottery stock or pick a option contract to try and gamble on. Really what it's about, in my opinion, is building consistency, building the discipline to set money aside every month to grow that account. It's almost like it's a savings account, but you're not saving in dollars. You're saving by buying assets that are going to grow over time, because as the portfolio grows and it starts to get something sizable, 10, 50,000, whatever it may be, now you're earning, if you're invested in the S&P 500, you're earning about 10% a year. And so it starts to grow on itself with that compounding return. And so I'm a really big proponent of save a little more than last time. If you let's say this week you only managed to save $20. Well, next week, make your goal $25. And the week after that, make it 30, 40, 50, and just keep growing it. Keep trying to save more and snowball your way in. You don't have to go crazy. The most important thing is to get that snowball rolling, and then you'll really start to build wealth and start seeing that snowball go from a little marble, and it starts growing and bigger and bigger. And now you have this mountain of a stock portfolio sitting in front of you. It just takes time, discipline, and consistency. And so today, all I did was I added more to our Ethereum position. Again, the account is small. I'm not chasing crazy option contract type things. I am investing in an asset that I believe has really high growth potential, because if we, again, we're seeing stable coins. We saw BlackRock come out saying that they want to tokenize the entire stock market. Right now, Ethereum's the dominant platform for tokenization of assets. We're seeing stable coins getting launched by pretty much any financial institution you can think of. They're coming out and announcing that. So I think there's a lot of growth potential here. And when a portfolio is in the beginning stages, if you're able to invest, or if you're able to spot an opportunity that is both safe in a way, because in my mind, it's safe in that if blockchain technology is going to succeed, this is the blue chip. This is the Google of this industry. And so I view it as a blue chip. I don't see that as being I'll put it this way, it's as safe as you can get within crypto, short of maybe buying into Bitcoin. But you still have that asymmetric return where you're investing a small amount and it could potentially go up substantially over the next 5-10 years, which would have a huge impact on the portfolio's performance. So that's why right now in early stages, we're focused on building this up. So that's pretty much it. We just added the $200 to the portfolio, added it into the FE to try to balance between BlackRock and Fidelity's fund. So now I kind of want to talk about managed funds versus actively managed funds versus investing in index funds, because there's a really big difference. And one of them feels kind of scammy to me, because if we look at statistics, it's something like 98% of actively managed funds cannot beat the market benchmark, but actively managed funds are going to charge you more. So what is the purpose of, if I'm not getting a higher return, right? So let's say that they're on par with the S&P 500. Well, they are going to have a higher expense ratio. What's an expense ratio? An expense ratio is basically what the fund is charging you to manage it. Essentially, they're charging you to take trades and try to beat the market. But if the majority of funds are unable to beat the market, it really doesn't make sense to be paying a higher expense ratio. So let's say that you have an actively managed fund and then you have an ETF. that's just tracking the S&P 500. So and let's say that they're both earning 10%. Well, let's say that the actively managed fund is charging you, I don't know, 1% expense ratio. So your real yield there, your real return isn't 10% because you got to take off 1%, which is going to go to pay the fund manager. So now it's 9%. And so it's really important to kind of pay attention to those fees, because 1% compounding over 10, 20 years of your retirement can really amount to a lot of money. So that's why I kind of say like it's kind of a scam, because it's not a scam in the sense that they are stealing money from you, but they're stealing the opportunity cost of what your money could grow to become, because you're not really getting anything from it. You know, if I was paying 1% expense fee and then they were beating the market by like, you know, I don't know, like 50%. So, you know, instead of it being on par with the market at 10%, they're beating it by like another 5%. So they're making 15 or 20% of the market. It's like, okay, well, maybe it's worth it then. But that's not really the case majority of the time. A lot of these actively managed funds, I'll look at them and it'll have like a high expense ratio and they'll have like a 7% return. And I'm sitting there questioning, I'm like, why would anybody buy this? You know, this is ridiculous. Why, you know, they're essentially just eroding your profit potential by being invested in their fund. It's a scam in the sense that they come up with an idea so that they can earn revenue. They don't necessarily care about making you the most money possible, because if that was the case, you know, if you want to make the most money possible in a safe manner, you just buy ETFs, low cost Vanguard ETFs that are charging like a 0.1% expense ratio. You don't even feel it. So here, I'll show you what I mean. So this is an Ethereum ETF, and you'll notice that most of them are coming in. They have a fee here, 0.25, 0.25, 0.2, but then we come all the way over to Grayscale, and they're charging a 2.5%. Now, why are they doing that? Well, it's because they have a ton of people that are locked into this ETF. And so they're just, instead of coming down to what all the competition's market is, they know that they have these clients trapped. And so they can take advantage of that and charge them the 2.5%, because if they sell, now they've got to pay capital gains tax on realizing whatever gains they may have realized. So, it's kind of a question of, paying long-term or short-term capital gains tax, taking anywhere from like a 15, 20% hit to 30% or more to get away from this 2.5% fee. So you really have to watch these expense ratios. They can really eat into profits over time. Now, being in something high growth like an Ethereum ETF or like a Bitcoin ETF, you don't feel it as much, but it is there. So just something to keep your eye on. So I think that pretty much wraps up this video on this month's portfolio update. So I will catch y'all in the next one. If you have any comments, leave them in the comment section down below. Until next time, y'all take care.